There's a moment in every wealth story where the path splits. One road looks solid enough to touch doors, deeds, keys, rent checks. The other looks like numbers on a screen, tickers, charts, headlines, and days where your account balance swings like a mood. Both roads can make you wealthy. Both roads can break you if you pick them for the wrong reasons. And the twist most people learn too late. The best investment isn't the one with the highest return. It's the one you can hold through fear, boredom, and temptation. If you want more breakdowns like this that cut through the noise, subscribe now, because the choices you make with your next dollar will echo for decades. Let's step into the showdown. Scorecard that actually matters. People argue real estate versus stocks like it's a sports debate. I don't care about opinions. I care about mechanics, the forces that quietly decide who wins. Here are the real categories: how you get paid, how fast you can get out, how taxes treat you, how much work it takes, how mistakes punish you, how emotions sabotage you, how big you can scale, how resilient it is in bad times. Keep those in mind. They're the difference between building wealth and building stress. When you picture being wealthy, do you picture freedom from a job or pride of owning something real? How you get paid, cash flow versus compounding. Real estate pays you in cash flow if you buy it right. Real estate's promise is simple and seductive. Someone else pays your mortgage. You can earn money monthly through rent, and if you structure the deal well, the tenant covers mortgage interest, taxes and insurance, repairs, indirectly through your rent pricing, and maybe even a profit margin. But the truth people skip: cash flow is not guaranteed. It's engineered. Bad purchase price, bad financing, bad neighborhood, or sloppy property management. And that passive income becomes a second job with surprise bills. Stocks pay you through compounding, if you can leave them alone. Stocks can pay dividends, sure, but their superpower is scalable compounding. You can buy a slice of thousands of businesses, reinvest dividends, keep adding monthly, and let time do what time does. The catch is psychological. Stocks can feel like they're betraying you right when you're doing the right thing, because volatility is the admission price for long-term growth, which would keep you up at night more. Your roof needing a $12,000 repair, or your portfolio dropping 25% in a bad year. And if you're getting value so far, hit subscribe, because next is the part most people never calculate until it hurts. Control versus convenience. The hidden cost is you. Real estate gives you control. You can force improvements, renovate, raise rents within market limits and local rules, change tenants, add bedrooms or units where allowed, improve curb appeal and operations. That control can create forced appreciation, wealth you manufacture, not just wait for. But control comes with responsibility. In real estate, you are the shock absorber for life's chaos. Vacancies, late payments, plumbing, storms, insurance spikes, HOA issues, local regulations, and the big one, bad tenants. Stocks give you convenience. You don't fix a broken furnace for Apple. You don't get a midnight call from Microsoft. You can buy, hold, and live your life. But the trade-off is helplessness. You can't control the market, the Fed, earnings, or sentiment. You're riding the wave, not steering the boat. If you've ever said, "I want something I can control," real estate is calling you. If you've ever said, "I want my life back," stocks are calling you. Number 3, liquidity. How fast you can escape a mistake. This is where the suspense turns real. Stocks, liquid in seconds. You can change your mind on a Tuesday morning and be out by Tuesday afternoon in normal markets. That liquidity is a safety valve. But liquidity has a dark side. It makes panic selling easy. Real estate, illiquid for months. Real estate is slow. Selling can take weeks or months. Closing costs are real. The process is heavy. That illiquidity can protect you from impulsive decisions, but it can also trap you when you need cash fast. Now picture this. Let's assume your income dropped tomorrow. Which would you rather own? Something you can sell in a day, or something that might take 90 days to unload? 4. Leverage, the accelerant that can build or burn. If there's one reason real estate has minted so many millionaires, it's this. Real estate makes leverage normal. In real estate, borrowing is baked in. Putting 20% down to control 100% of an asset is standard. That means your gains and losses can be amplified. If property values rise, your equity can grow faster than if you paid all cash. Meanwhile, tenants can effectively pay down your loan over time, one of the most underrated wealth mechanics on earth. But leverage is not free money. It's risk with lipstick. If rents drop or vacancies rise, the mortgage still wants to get paid. If rates reset or refinancing becomes ugly, your good deal can turn fragile. Stocks. Leverage exists, but it's optional and often dangerous. You can borrow to buy stocks, margin, but it's less forgiving. A market drop can trigger margin calls and force you to sell at the worst time. So, leverage is a bigger part of the real estate edge, if you manage it with respect. If you want more breakdowns like this, real talk, no fluff, subscribe. This is how you avoid the, "I didn't think about that," regrets. 5. Taxes, where real estate often lands a punch. Taxes are where real estate often looks like it's cheating. Real estate tax advantages, often powerful, sometimes complex. Depending on your situation and local laws, real estate investors may benefit from things like depreciation, a paper expense that can shelter some rental income, deductible expenses, repairs, management, some travel, etc. Potential deferral strategies in certain cases. The ability to structure ownership and expenses with professional help. But none of these are automatic, and mistakes can be expensive. Real estate tax benefits rewards people who keep clean records and get good advice. Stocks tax advantages. Simple, clean, scalable. Stocks can be tax efficient too, especially with long-term capital gains treatment, tax-advantaged accounts, retirement accounts, etc. Index funds/ETFs with low turnover. Stocks usually win by simplicity. Real estate often wins by strategy depth. Side note, tax rules vary a lot and change over time. Treat this as education, not personal tax advice. Costs and friction. The silent leak. Real estate friction is high. You pay in more ways than you think. Closing costs, inspections, appraisals, ongoing maintenance, property taxes and insurance, legal compliance, vacancies and turnover, management fees if you outsource. Real estate can absolutely build wealth, but it's a machine with moving parts. Machines require maintenance. Stocks friction can be low. With low-cost index funds/ETFs, your costs can be minimal compared to real estate, and your time cost is tiny. The most expensive stock cost is often behavioral, chasing hype, selling in fear, buying in greed. Do you trust yourself more with a system that is automatic investing or with decisions, buying, managing, improving a property? Risk. Different monsters in different closets. Real estate risks. Concentrated risk. One property, one neighborhood. Tenant risk. Repair and catastrophe risk. Regulatory and zoning risk. Rate and refinancing risk. Time risk. Your attention is a resource. Stock risks. Market drawdowns. Sequence of returns risk, especially near retirement. Business risk. Mitigated through diversification. Emotional risk. Panic selling and performance chasing. Here's the emotional truth. Real estate stress is often loud and specific. Stock stress is often quiet and constant. Inflation and sleep at night factor. Real estate often feels like a tangible inflation hedge because rents and property values can rise with inflation over time, not in a straight line. Fixed-rate debt can also feel like a cheat code when inflation runs hot, because you're paying back tomorrow's dollars with yesterday's debt. Stocks, on the other hand, represent ownership in companies that can raise prices and adapt. Over long periods, many businesses can pass inflation through to customers. Again, not perfectly, not always, but often. So which wins? Real estate can feel safer because you can see it. Stocks can be safer because you can spread risk across the world. So, which one is the ultimate wealth builder? Here's the answer that sounds boring until you live long enough to respect it. The ultimate wealth builder is the one you can stick with. If you have high income, stable cash reserves, patience, and the temperament to handle operational issues, real estate can be a wealth accelerator, especially with smart leverage and disciplined underwriting. If you want flexibility, low overhead, instant diversification, and a plan you can automate for decades, stocks can be a wealth engine, especially through consistent contributions and long-term holding. And for many people, the real ultimate play is not either or. The hybrid strategy that quietly wins. Build a stock base for liquidity, diversification, and compounding. Add real estate for leverage, potential cash flow, and tax strategy when your finances and bandwidth can handle it. Use REIT if you want real estate exposure without toilets, tenants, and phone calls. REIT stands for Real Estate Investment Trust. It's a company that owns, operates, or finances income-producing real estate. Now let me ask you this. If you had to choose one for the next 10 years, no switching, what would you pick? And what's the real reason behind it? The decision that decides everything. People don't fail at wealth building because they pick stocks instead of real estate. They fail because they overextend in real estate and can't survive vacancies or repairs. Or they bail on stocks during drawdowns and lock in losses. Or they keep waiting for the perfect time and never start. Your wealth isn't built in your best year. It's built in the years when you feel doubt and keep going anyway. If you want, tell me 3 things and I'll help you think through which path fits your reality. Your time available per week, 0 to 2, 3 to 5, 6+ hours. Your risk of comfort, low/medium/high. Your goal, cash flow now versus maximum long-term growth. And if you want clearer, practical breakdowns like this, subscribe, because this is the stuff that changes outcomes. This video is for educational purposes only, not personalized financial advice. Consider talking with a licensed financial advisor/tax pro for decisions tied to your specific situation.